When I did the building blocks of technical analysis, it's been running, I know, on StockCharts TV. I did it December 18th, so it's been on StockCharts TV, the live version, a couple of times, but you can also go to the StockCharts YouTube channel and look up building blocks of technical analysis, and it'll bring up part 1 so that you can go through that. But basically what we did in part 1, we looked at price bars and time frames, so how a candlestick and an OHLC bar, it works, what's intermediate term, what's not. Excuse me, let's go back. We looked at support, resistance, and how to draw trend lines. We went over the different moving averages, and I talked about the basic indicators, the moving averages and momentum. And then I got started on price patterns, but I wasn't able to really get into that. So here's what I'm going to do today. First of all, I'm going to do just a quick technical analysis lingo for beginners out there. And then I'm going to go over divergences in a kind of an, I'll be looking at it a little differently. It's going to be, I did a very complex divergence, convergence workshop before, so I'm not going to go too in depth because you could look up my divergences web workshop as well. I'm going to talk briefly about the VIX and breadth, and then we will look at some of those basic chart patterns. So let's go ahead and get started because we do have a lot to cover right now. All right. So here's some of the lingo that we use a lot, I know. Outperformance and benchmarks. Outperformance, usually whether you've outperformed when you've compared to some sort of benchmark. It could be, I know when Julius does his and he looks at a bunch, or if maybe you're looking at your portfolio, you're looking at simply, which ones are doing better than the others? Am I, on the positive side? Am I on the negative side? So that's sort of an outperformance thought. But usually we use a benchmark, and the S&P is the benchmark. And a benchmark means you're making a comparison between what you are looking at, the stock or whatever it is, in relation to the S&P. Did it do better? Did it do worse? And of course, all of the brokers, all of us, out in market timing, everyone, we're trying to beat the S&P. We want to do better than the S&P. So that's what a benchmark is. All right, the symbols, I know some people have asked about, what is the dollar sign and what are the exclamation point symbols? Dollar signs give you indexes generally, and the industry groups. Like we always look at the Dow Jones US, software or, trucking or whatever it is. Those are going to be with dollar signs. And then the exclamation point symbols that you'll find, those actually migrated from decision point. So it is indicators. It'll give you an indicator set, like new highs, new lows, or sentiment up, down. That's going to be preceded by an exclamation point. So that's the difference, at least on StockCharts, with how we use the dollar sign and the exclamation point. If there isn't either, then it's an ETF, stock, or mutual fund. Buy and sell signals. This one is a little tricky in that, market timers, we use it all the time because that's our benchmark. We have to see, are we good on our signal for the buy, and how did that do versus a sell? And then decision point also has neutral signals. And so I'll go into that in a little bit. Sell into strength. I know we've been saying that a lot lately, Tom. Basically, if you're in a bear market situation, which I believe we are right now, if you haven't divested from certain issues that you have, if you haven't divested out of certain stocks or certain industries, but you're feeling that it's bearish and they're probably going to suffer because of what's happening in the overall market, or if it's in the NASDAQ 100, so it might suffer because Apple's not going to be doing well. So so selling into strength means that when you're in that bear market, it's not going to go down every day. So when it does go up, like we really have been experiencing now since the end of December, since then we've been making this move to the upside. I still believe we are in a bear market, So take advantage, you sell into strength, you take advantage of that bump to the upside and divest before it goes down into weakness. So that's what sell into strength means. Divergence and convergence, I will go over that. That's really an analysis technique that we use to determine whether a stock or ETF or index or industry, what the comparison is between an indicator and the price of what's going on. And then we measure whether it's diverging or converging. And again, I'll show you some examples shortly. And then we'll talk about VIX and Breadth. Some of you read my article before, and one of our viewers, I wish I could give him credit because I don't know. I don't know who exactly it was, but he had mentioned when I go over my VIX and Breadth chart, I always talk about the VIX and Breadth, and it sounds like VIX and Breadth. So anyway, so we'll look at the VIX and Breadth and kind of what those mean and how you can use those. All right, so here are those signals. Remember, I was talking about buy and sell signals. So what we have here are the various kinds of signals. Now, I think the easiest way to look at what a buy and sell signal is for a decision point is just using the PMO. And you can use this with the MACD, you can use it with however you do it. And so your signals are sell signals, if you're looking at the PMO, are downside crossovers, move below the signal line. That's why we call it the signal line. It tells us what the signal currently is based on where the indicator itself is. And of course, the signal line is simply a moving average. So when you look at these downside crossovers of the signal line, that's considered a sell signal. And of course, the upside crossovers are considered a buy signal. Now, I brought neutral into the game here because in decision point, we follow moving average crossovers. And that's how we come up with our short-term, intermediate term, and long-term buy, sell, and neutral signals. So the easy one is the 50-day EMA and the 200-day EMA. An upside crossover is buy, and a downside crossover is always a sell. So the long-term trend model, you're only going to get a buy or a sell. Now, unfortunately, when you go to the short term and the intermediate term trend models, now you have to add in the neutral signals. And the neutral signals are simply, how I talk about with decision point, if a stock has the 50-day EMA above its 200-day, that it's in a bull market configuration. That's why we have a neutral signal, because if our negative crossover of the 20 and 50-day EMAs, if that occurs above the 200-day EMA, we make it a neutral signal because you're still in a bull market configuration. And so you don't, maybe you don't want to. Some of our more aggressive decision point followers use a neutral like a sell. But for us, if you're in a bull market configuration, your expectations should be more to the upside. So we go with more of a neutral, which means fully hedged or in cash. Now, obviously, you're not going to have your whole account in cash necessarily or fully hedged. But when you're looking at that stock, maybe you want to pick something from an opposite industry group or something that might travel differently to hedge against the fact you got this neutral signal. So those are buy and sell signals. So let's look quickly at divergences. There's the positive divergence. So actually, let me go back just quickly. So here are the different divergences: positive divergence, and then right piggybacking on that is the bullish confirmation. There's the negative divergence. Piggybacking off of that is the bearish confirmation. And then, of course, we get to confuse things completely by adding reverse divergences. So I'll give you a look at this. And I did do that workshop on divergences. Highly recommend you go check it out if you want to get a little bit more in depth about what I'm talking about. So with divergences, positive and negative, you start with the indicator because you're looking at rising bottoms and declining tops. Remember, there's no rising tops line and there's no declining bottoms line. I mean, you could certainly mark that, but it's not the classical. Hey, why don't we keep going back? Okay. So I start with the indicator and I have a higher high on the bottoms, rising bottoms on the indicator, but on price I have declining bottoms. So that's considered a positive divergence. momentum, say this is a momentum indicator. Momentum is still building even though it moved lower. And now you've got that deep dip in price, but overall the momentum is still to the upside. So that's considered a positive divergence. You should expect a bullish move or a rally in this case. So here you go. So there's well, that's not very good. That's the confirmations. So negative divergence is starting with the indicator again. Now you're looking at declining tops, and then you compare that to price, and they're rising, right? So with declining indicator tops, like think about it as the momentum, even though the price is starting to go up, the momentum is slowing. And so that is a negative divergence. Momentum is slowing, yet price is rising against that. And so that tells you that there's some problems with this rally, that you should expect some weakness. And that's why you look at this as a bearish divergence. All right, and then there are the confirmations. And the confirmations are pretty simple in that, we used rising bottoms on the indicator, right? And we used declining tops on the indicator. Well, if the price is going the same way as the indicator, then that's a bullish confirmation. If they're both moving up and higher, that's bullish. If they're both the declining tops, that's a bearish confirmation. So that's just telling you that the indicator is in line with price is in line with the indicator, and so you can expect a continuation. Reverse divergences, the best way I can explain is you start with the price, or the upper window, and then you draw your rising bottoms and declining tops on price, and then you compare those to the indicator. So here's an example. So we started with price, because remember, there's a rising bottoms and there's a declining tops. Those are the two things we look at in technical analysis. So if you're starting with price and you're looking for a confirmation, or a divergence, a reverse divergence, you start with price, so we have the rising bottoms, and then you look at the bottoms on the indicator. So we have rising bottoms on price and declining bottoms on the indicator, and so typically that's considered a negative reverse divergence. The opposite would be declining tops, but you're seeing rising tops on the indicators. So the indicator is rising despite the fact that price is moving down, and that's considered a positive reverse divergence. So again, the difference is that you're comparing you start with the price and look for rising bottoms and declining tops. All right, VIX and breadth. So the VIX basically measures the volatility of the market. It's like our fear gauge. It tells us it's the options market. It makes a comparison, and we can tell the implied volatility, and we use that to measure the overall volatility. Breadth is simply compares the number of issues traded with the number of issues listed for trading. So you have a closed universe, say, of the S&P 500, and we look at advancing issues and declining issues. So which ones were advancing and which ones were declining. And then we use the advance minus declines as another indicator. So here is there's the advancing declining issues, and then also new highs and new lows. Those are all the indicators we use with breadth. I'm sure there's more, but those are the typical ones that we look at. All right, so let's make a comparison. All four of those are on this chart, so it's a perfect example. This is my climactic indicators chart. So the breadth I look at, and the VIX, as very, very short term. And it helps me with looking for initiations and exhaustions. Okay, so let's start with the top one here. New highs, new lows. So in this case, there were only 13 new highs in the S&P 500 on that day. And then when we look at the advances minus declines, it's all the advancing issues minus all the declining issues. So if you get a negative number, that means more were declining than were advancing. And so we make a comparison of that. And I do also the one for volume, because you can do that as well to look at the breadth. So in this case, I'm not going to give you a whole reading of this chart, but we're seeing that in this, you can see that overall we were looking at breadth numbers, the advanced declines moving downward, and that's what I was looking at downward here. We really for a while weren't seeing any new lows or new highs, but that's because we had so many new lows. You have so many that are way down there. It'll take them a long time before they can get back up to make a new high. So that's why we didn't have any there like we would normally see. And there is the VIX, and you see us talk about it all the time. The lower numbers mean that people aren't as fearful, and the higher numbers mean that people are very fearful. And so what we do is we look at where it travels, and the wider this Bollinger Band is, that tells you the more volatile the market is. I mean, I think that we all knew when we were going through these times and continue to go through these times that we're having, it's quite volatile. So I look at this is an inverse scale, because if everybody's very, very comfortable and you've got puncture on that upper Bollinger Band, people are very comfortable, that's usually when you get the reversal in the short term. And vice versa, when people are very, very fearful and very bearish, that's about the time you need to start looking for a reversal to the upside. So that's why I invert it that way. All right, so I want to get into some of the chart patterns, and I did do a chart patterns workshop that I recommend you go take a look at. And I don't know why this is being kind of ugly, but I'll go over the ascending and the symmetrical triangles. I'll look at a bull flag. We'll look at a descending wedge. We'll look at the double and triple bottom and rectangles, as well as I don't have it in here, but a head and shoulders. We'll look at that as well. And like I said, that was covered in Trading Chart Patterns, and I did that workshop in July. And I probably am going to do, I think that might have been the first one, and I think I did a 2.0. So just look that up on YouTube, and you should be able to find those and get even more detailed than what I'm going to go over now. But I'm looking at building blocks, and this was one of the first things I learned after learning support and resistance and trend lines and all of that. One of the things my dad, when he was helping move me and teach me along the way as from teenager on up, he showed me very early on was the chart patterns. And I got Thomas Bulkowski's Encyclopedia of Chart Patterns, a super fat book. Big look, it is like an encyclopedia from back in the day. I mean, he's done tests on them. He talks about all different kinds that we generally don't look at, scallops, and I mean just some very strange ones. But he's the guy to look up, Thomas Bulkowski. We also had the visual guide to chart patterns in the StockCharts bookstore, also really good for covering chart patterns. So those are the bullish chart patterns. So let's go ahead and we'll look at some of those. So the first one I'm going to look at is the ascending triangle. And this one can be a continuation pattern or a reversal pattern. Well, what does that mean? Continuation means you're going to continue in the same trend you were already in. A reversal pattern means that when you see the pattern, you should expect the trend to be reversing if it executes. Now, in this case, like I said, with the ascending triangle, it can be either of them. So it doesn't have to occur at a certain place or a certain time. And the idea is you have rising bottoms, yet you still have this overhead resistance. And so the prices are getting higher and higher. And what we look for is that burst to the upside, and that executes that ascending triangle. It's bullish, so the expectation is an upside move. Now, remember what I've been telling everybody, though, if you have that 50-day EMA below the 200-day EMA, you're in a bear market configuration. And what do? We expect the bearish outcome over the bullish outcome. So had we been in a bear market situation here and this came up, my expectation would not necessarily be the breakout to the upside, because I'm in a bearish market. There's a certain gravity, that pulls down on price because of that. And so I wouldn't expect to see it break out. I would expect to see it break down in a bear market configuration. The symmetrical triangle is typically a continuation pattern. It can break in either direction, but typically it goes into, it just continues the trend. But it's a time of indecision. Nobody can really grapple and grab the market. And it just gets to a point and either the bears win or the bulls win. So the symmetrical triangle is just interesting in knowing that there's, indecision, there's people are, there's pushing and pulling. And so they're interesting to find, and then it can give you a sense of what's going on in the market in general. Now look at this, the 50 was below the 200, and a symmetrical triangle can actually go in either direction. But the 50 is below the 200, so what would we have expected? We would expect it to break down, and sure enough, in this case, it did. All right, the bull flag, and I've gone over this a lot, so I'm just going to really do this, the flags quickly. So it looks very much like a flag. You get a flagpole, and then you'll either get a little declining trend channel, maybe even a little bit of a rising one, or you'll see that pennant, that symmetrical triangle on the end of it. And these are continuation patterns, so they should occur in an upward move. If you're getting them somehow, I don't know, and you're in a declining trend, it wouldn't be as accurate. So once you see these, it's a measured chart pattern, so you can measure the length of that flagpole to give you a minimum upside target. But anyway, I'm not going to go into detail there because I know I covered that pretty deeply in both the building blocks previously and the chart pattern workshop before. This is the descending wedge. This is a positive chart pattern. When you see prices coming together here as they move down, that's a descending wedge. And so you're supposed to expect an upside breakout. And the 50 was above the 200. So my expectation would be that would have executed, and it did. Double bottom formations, the W's. I think this was the first one that I learned because it was so easy to spot. And you look for the two bottoms. These are reversal patterns. So these you should expect at the end of a downtrend. If you're getting them in the middle of an uptrend, it's not really as valid. So I wouldn't look at it that way. But you can see here we had that double bottom, and then you have the middle of the W, and that becomes your confirmation line or neckline. I use that because it's what I use all the time for head and shoulders, but the confirmation is right there at the middle of the W. The expectation is an upside breakout. Now the 50 was well below the 200. So in all honesty, when we got here, while I was looking for a possible breakout, we were still in a deeply, it was in a bear market configuration back here because the 50 was below the 200. However, divergences, remember? Rising bottoms on the indicator and declining bottoms, almost even bottoms on price, that's a positive divergence. So you add in the fact that you had a bullish chart pattern as well as a positive divergence. I would be willing to forgive the fact that the 50 is that far below the 200. And you do the measured move when it breaks through. The amount that it moved up, that's the amount you should expect it to move up after it's executed. And typically it will reach that. And sometimes, interestingly enough, it'll land right there on support and resistance. All right, triple bottoms, pretty much the same idea, only your confirmation line is over those two peaks that are formed by having a triple bottom. And just like the double bottom works the same way, you can do the measurement to get your upside target. And the rectangle, pretty boring pattern. Basically, it's a trading channel. You're moving back and forth, up and down, obviously within the channel. Typically that shows you if you're on, you've been on this uptrend and then you start to just consolidate. It could be a chance for prices to take a break, and now you can get that upside breakout. But it could also break down there too. So it could be a reversal pattern. And you'll watch, usually volume will start to dwindle for the beginning into the end of that pattern, and it'll rise if we're going to get a breakout at the end, and it'll start to, if we're going to get a breakdown, you'll really see volume start to peter out. All right, bearish chart patterns. Let's go through these. Descending triangle, rising wedge, bear flag, double and triple tops, head and shoulders. Oh, well, we'll do the bear flag. All right, so let's start with the descending triangle, this bearish pattern. Basically opposite of the ascending one. Flat bottom, declining top, and the expectation is a breakdown. It can be a continuation, as it was in this case, or a reversal. And we had, if you look, we had declining tops on the indicator, declining tops on price. That's a bearish confirmation. So I would have expected it to execute. Plus, we had the 50 below the 200. Ascending wedge. These are the opposite, of course, of the descending wedge, which is bearish, could be continuation or reversal. You should, though, expect a breakdown of these patterns. That's typically what you're going to see. In this case, I may have been a little, I would have probably, we failed at overhead resistance. This formed, so even though the 50 was above the 200, I would be looking for a breakdown just because we failed to continue on that rise. We didn't get that far above that previous top. And basically it hit it and then fell back down. And then you can see right after that, it started to break down below that channel, and then that was pretty much it. The reverse flag, pretty much just opposite the bull flag, looks very similar. And with flags, you kind of want, with the bear flag, you sort of want the flag to kind of be moving upward. And with the bull flag, you kind of want it to be moving downward. Bearish double top, similar to the double bottom, so I won't go over that too deeply. Triple top, same idea, just different, the opposite of the bull pattern. Head and shoulders, everybody talks about these a lot. Looks like a shoulder with that big head on the top there. And then this is the neckline. These are bearish patterns. The expectation is a breakdown, and they are reversal patterns. So, you're going to have I guess you might say, a better expectation of the breakdown if it's a reversal. If this came in the middle of a decline, it's not a continuation pattern, so I just don't look at it as a valid pattern. Reverse head and shoulders, I didn't talk about those, but it's, of course, the opposite, and it's a bullish pattern. The expectation is a breakout above the neckline. All right, so our summary from part one, we went over those price bars, moving averages, basic indicators. So again, go ahead, look up building blocks of technical analysis on StockCharts YouTube channel, and it will come up, and you can watch part one on your own. And this was part two, and that's what we covered. We looked at the lingo that we use a lot, divergences. I talked about the VIX and Breadth, and we did look at those basic chart patterns. So that concludes my workshop.